Good evening. I'm Swanda Flowers, and I'm a veterinary lender with First Financial Bank. And it is a privilege to be here with you to be able to talk about managing student debt and really finding a pathway to financial freedom. So I'll introduce myself so while you can see my face, and then we'll start a presentation where I want to talk a little bit about student debt and how that impacts your ability to find your path to ownership, and also just some strategies for managing that debt and what you should know about that debt from a lender perspective. So as I said, my name is Swanda, and I work with another wonderful lender, Ashley Moore, and we split the country. So First Financial Bank is a national lender. I work in the East and Ashley works in the West. And we focus all of our time in the veterinary practice, animal hospital industry, and pet care industry. My background is actually in pharmacy. So I have a doctor of pharmacy degree and practiced pharmacy for several years and owned an independent community pharmacy. And so my perspective on lending is a little bit different because I do come at it from the perspective of an owner rather than a banker. And I hope that, that helps as I work with customers all over the country, just to really let them know, one-on-one that I can help with business planning, cash flow, projections. We want to be a resource and really encourage ownership. So we will get started with tonight's presentation. I am going to go ahead and share my slides. If you have questions about the presentation or about anything else, my contact information is on the last slide. And so I would love for you to email or call me directly, and I'll be happy to answer any of your questions. So we'll get started. Okay. So pathway to financial freedom. I think that, when we talk about the pathway to financial freedom, it is important to really think about the elephant in the room. And we get a ton of questions about student debt. And so tonight I do want to encourage you a little bit and talk about student debt and different ways to manage that. But we'll also talk a lot about pathway to ownership. And so we're going to kind of join those two into this presentation for you today. So we're going to talk about what's going on in the industry. There is a lot going on in veterinary practice and animal health. The pandemic obviously has had a lot to do with that. And so I do want to talk a little bit tonight about what we're seeing and hearing from customers and potential customers and your colleagues across the country. I want to talk tonight about ways to manage your student loan debt, the do's and don'ts as you're thinking about that leap into potential ownership. We'll discuss some of the resources that are available, both managing debt and in getting you started on your path to ownership. And then what does that path look like from a lending perspective? What does that really look like? So first of all, student loan debt can be very stressful. And it is something that causes a lot of concern for a lot of healthcare professionals. And I know that many, many years ago when I was in pharmacy school, the cost of higher education and a professional degree programs just was not what it is today. And so first of all, what we want you to know is that your student loan debt, it is a necessity. You have to have that degree in order to be able to practice. And so we don't hold it against you. Right now, the average student loan debt for veterinary practitioners, so DVMs, is about $180,000. Now, obviously, some of that depends on where you chose to go to school, professional school, also where you received your undergraduate degree. There are a lot of variables there across the country in different areas. but on average, it's about $180,000. And although that seems staggering when you think about the average associate salary being around $80,000, we're going to share some ways tonight that might make you feel better about getting that paid off faster. The price of practicing is getting higher. And you're not alone. I think a lot of young associates we talk with think, I have all this student loan debt and this is completely overwhelming. And, a lender's not going to understand, that I had to have those loans. But in fact, you're not alone. We see this all over the country. We see it from associate veterinarians. We see it from other healthcare professionals, and it is manageable. And it is not going to prevent you from realizing your dream of ownership. So the number one mistake that I think graduates make is really thinking that there's only one path and that when you graduate, you don't have any options. There are a lot of graduates who really feel like, okay, I've got all this student loan debt. I've got this offer, from a corporate environment. They're going to pay the most. I need to take that job because I need to make as much money as possible so that I can pay my student loans off. And while that may be attractive, a higher salary obviously is always attractive. We do want you to feel like you have the freedom to practice the way you intended to practice and that you were taught to practice. And so don't feel like you have to take, a job that you're not happy with. You will be able to pay off your student loan debt. We do understand that it's there, but you do have other options. Do not feel like you're trapped. And that there's only one path. A path that you probably don't consider very often or very early in your career might be ownership. And so we'll talk a little bit tonight about that timeline and what's reasonable from a lending perspective, and hopefully just encourage you to start thinking about that. An interesting statistic that we found is that there was a survey done of veterinarians across the country in 2018. And they asked, what are the top 5 changes that DVM owners would have made in their practices that previous year? And the answer was not, I would have, reined things in, or I wish I hadn't gone into ownership, or I would sell, or it wasn't any of those things. It was actually that I wish that I had expanded my business. I wish that I had created more exam space. I wish that I had remodeled. I wish that I had purchased additional equipment to provide more services. It was all about, the fact that these DVM owners realized there was opportunity and that they would have expanded their business. So when we think about our student loans, as you guys are getting out of school, there is some help out there. And, a lot of these things are they are common sense, and just take a moment to step back and think about, okay, what are my options? Look into government programs. There are forgiveness programs. And right now, a lot of you may, if you're recent graduates, may have deferment, for your student loan through the SBA, or through the CARES Act. And so I think that it's important for you to think about right now, okay, maybe those things are deferred. Can I still afford to make some payments on the principal? What are your options there? But look into all of the government programs that may be available, especially, these COVID relief programs. Military service. Certainly that is a way that a lot of students in various fields pay off some of their student loan debt. There are repayment programs, income-driven repayment programs. So, you can have a payment program where it is a fixed amount that you've agreed upon for X number of years, or it can be income-driven, and you can actually pay more or less depending on, the income that you're receiving that year. And then consolidation programs. One of the important things to think about is, is it smart to consolidate? And what does my interest rate look like? Really look at this loan like you would any other loan and make a good business decision about what is my rate? What are these terms? Does it make sense to consolidate these loans, or is it best to leave them alone? But really on an individual basis, take a look at all of your loans and know what they are. The first step is really understanding, what are you paying? What is your interest rate? What does that look like over time? And once you think about those things, just settle into, okay, this is where we are. This is my plan for repayment, and I'm going to stick to it. Okay. The most important thing is that you keep your student loans in good standing. Even if you haven't paid them off, even if you still feel like you've got a heavy student loan debt, as long as it's in good standing, then you're fine. So one of the best ways to get out of debt, very simply, is by increasing the cash that's flowing in, right? So more cash flowing in to you personally will equate to your ability to pay off your student loan debt faster. One of the ways, especially for those of you that have been out of school for a couple of years and practicing, is to think about ownership. And I think sometimes that's counterintuitive. And we talk to associate veterinarians all the time, and they're like, oh my gosh, I could never take on more debt. I already have all this student loan debt. How can I take on more debt? But I want you to hear me out. Let's walk through this. And I want to show you how ownership actually will give you the financial freedom that's going to allow you to pay your debt off faster. So practice ownership on average. If we look at the DVM salary, the associate DVM versus the owner DVM salary, on average, it's about 2 to 3 times higher for that owner DVM. If you own the real estate where your practice is located, then your compensation is even higher because you're paying yourself rent. And so all of those things will make it easier for you to repay your debt. You growing your wealth faster is what will allow you to have that freedom to make those choices. So I said earlier, your degree is a necessary expense, and it is. We are not going to hold that against you. What we are going to look at are things like revolving credit, so credit cards. If you can, your focus should be eliminating your revolving debt. So if you can have almost none or no credit card debt, that would be ideal. And then again, focus on all of your debts being in good standing. And that should be, your primary concern as well. So one of the biggest pieces of advice that I would give to all associate veterinarians out there is be prepared. And what I mean by that is be prepared to take advantage of an opportunity when it presents itself. You may think that your path to ownership is 5 years down the road, 10 years down the road, whatever that may be. But if in a year from now, you're faced with the perfect practice in the perfect location at a great price, you want to be prepared. And so start now by controlling your spending. Okay, so thinking about that, setting money aside for a down payment. You will be required to come up with about 10% of a down payment. And we'll talk about some options for that because that can be a huge barrier. But if you think about it early, you'll be able to start putting some of that money away so that you're saving for the down payment. Again, eliminate that revolving credit. Think twice about buying that brand new car, or potentially going on that trip. And I love to travel more than anything, and I think it's worth every penny when we can do that. But when you're really planning for the future and trying to control your spending, think about those things. I have 5 children. 2 of those are in college, and 3 more are on their way out the door to college. And I completely understand the stress that, as a family and then just individually for my children, the stress that they're under thinking about the amount of debt that they're going to have for their higher education. And so really start thinking about, okay, how can I control that spending if you're still in school? Try to take out as little as you can. If you are out of school and now practicing, just think very carefully about those financial decisions so that you are in a good position later to allow yourself to jump into ownership. Know what your credit score is. There are a lot of customers that we talk to, and they don't know their credit score. And that's something really easy that you can do. There are free programs out there. I think Credit Karma is one of them that is free. We use a TransUnion credit score at the bank. There are lots of different ones out there, but a free service that will let you keep an eye on your credit score and what's showing up on your credit report is very important to do. Is investing in real estate okay? So can I buy a home? Of course you can, absolutely. And I think that we have a lot of customers who are like, well, but if I buy a home, am I going to have the down payment? I mean, so there's a lot of juggling that you might have to think about, but at the end of the day, investing in real estate is okay. You probably are going to need to use that for collateral for the loan. So, be prepared that that might happen, but investing in real estate is absolutely okay. Keep good financial records. There are so many people that I talk to, every week, and they say, oh, I don't know if I can get my hands on my tax returns. Know where your tax returns are, keep good records, have those available, because the bank is going to want to see that. I'm going to want to see 3 years of your past tax returns. And so having that easily accessible just makes the process go much more smoothly. Also having an updated personal financial statement. And, this is interesting as we talk to people about personal financial statements, a lot of folks have never done that. And so I would encourage you to do this, go through this exercise of working on your personal financial statement and then keeping it updated, every 6 months. There are templates online. There's not one form that you have to use. Basically, you're going to be looking at your assets, so what you own, and your liabilities, what you owe to people. And the difference between that is your net worth. Could be positive, could be negative, but it's important to know. Now, what I'd like for you to do is to take that personal financial statement and work through all of it, have all of your debts on there, all of your assets on there, and then take a look at it. Now delete your student loan debt. I want you to take that off. Because from a lender perspective, what I do when I look at your personal financial statement, I want to look at it outside of your student loan debt. So if I take off your student loan debt, do you have a positive net worth at that point? And I would imagine that most of you do. And so keep that in mind, that when I look at that personal financial statement, I am going to look at your net worth outside of your student loan debt. The SBA has a Form 413 that we use. You can find that on the SBA.gov website. You're welcome to look at that and use that. That's a template that you would need to fill out if you were going to be applying for an SBA loan. And so it's not a bad idea to go ahead and use that form, but there are tons of others out there that you can use. Okay, I want to walk through an acquisition example just to give you an idea. When I say that an owner DVM salary is 2 to 3 times that of their associate DVM, I want you to understand where those numbers come from, kind of how we're getting them. So let's just say that you found the perfect practice. It's a 3 DVM practice. It grosses $1.5 million. We've put a few expenses on there. Obviously, the profit and loss sheet would have a lot more expenses than this, but just for simplicity's sake, we put some expenses there. One of them I do want you to pay attention to is the lease. Okay, so that number, $72,000, that's going to come back into play later on. But you can see we've got our total expenses there and then net profit. So in our example, the net profit for this practice every year is $225,000. And actually, would probably be a 3-year average, because that's what we want to look at. We want to look at a practice over the last 3 years. Okay, so how do we determine, what you're going to pay for this? Well, we will, during the process of, going through underwriting and before closing your loan, we will have an independent third-party business valuation done. Now, it's not a bad idea to think about, having a consultant or somebody like that work with you as you, look at the financials, we certainly will help you go through the financials of the practice, but there are lots of great resources out there to help you if you feel like you just would like somebody to work with you, every step of the way, from a consulting perspective. But one of kind of the best approaches is really the income approach. And the way the income approach works to valuing a practice is that it's based on cash flow. So we said that our net profit was $225,000. So essentially that's our cash flow. We're going to take that number and then we're going to multiply it by a multiplier. Okay, so we're going to use a multiplier on our cash flow. Right now, what we're seeing just industry-wide on average is about 4 to 5 times as being that average multiplier that's used. There are corporate entities right now that are offering 12 times, 15 times net profit. And what I'll say about that is just that, you will get outbid if you get into a bidding war, and we're going to talk about that during our do's and don'ts slide. But there are a lot of owners right now who really want to sell to a young associate DVM who is going to take their business and run it like they have for the last 30 years. And so don't be discouraged, by those multipliers, because there are still a lot of practices that are being sold to independent buyers. And I think right now there's sort of a heavy weight in the air, that corporates are buying everything up and it's just not possible, for an independent, for a DVM to buy anymore. And it's just not true. And so, there are practices out there. It may not be the first one you come across. It may not be the second one, but there are practices out there. So in our example, we're going to use a multiplier of 5. So when we apply that multiplier to the net profit, the total purchase price is $1,125,000. Okay. So in addition, there's going to be some closing costs. Maybe we need to put some working capital in there. Those types of things will go into adding to that total project cost. So your total loan amount is not your purchase price. Okay. There are other things that are going to need to be added in there. And then you're going to be required to come up with 10% down. Now, there are a couple of ways that you can do that, because I mentioned earlier that sometimes that 10% cash down is the biggest barrier for associate veterinarians getting into ownership. The seller can actually carry half of that on full standby for you. What that means is that half of the 10%, so 5% of the total project cost, the owner can carry on full standby, and you would not pay them back until the bank loan was paid off. Okay, now some of you listening are probably thinking, that's crazy. Nobody's going to do that. A seller would never do that. But again, you would be surprised. You would be very surprised at how many sellers are very willing to carry 5% on full standby. So in our example, that's what's going to happen. But ultimately, you've got your 10% down, and then the bank loan is going to be for $1,143,000. All right. So let's just say 5% interest rate. Right now, interest rates are lower. Interest rates are phenomenal right now, so keep that in mind too. But let's just say you had a 5% interest rate. This would be a 10-year practice loan. Your monthly payment would be just over $12,000, and your yearly payment would be $145,479. Okay, so let's go back and think about what would that cash flow be now? Because from a lender, I'm always looking at cash flow. What is our cash flow? Can you service your debt? You have to have the cash flow there to be able to service your debt. So we take our net profit, $225,000, because we know that's the net profit average over the last couple of years for this practice. We're going to take out your annual debt service, that $145,000. You're left with $79,500. Your owner DVM salary, because of course you're paying yourself, you're working as a DVM in the practice, is $88,000. So your owner income is $167,521. If you were working as an associate in this practice, you would probably be bringing home $80,000. But now as the DVM owner, you're bringing home over 167,000. So that gives you an additional 80 something, 90,000, right? To pay off your student loans faster, to pay off your practice loan faster. But as you can see, there is a lot of available cash there to service the debt. Okay, now we want to add just another little twist. And let's say you're able to buy the real estate. So this 3 DVM practice that's for sale, the DVM owner also owns the building, the real estate where the practice operates. And he's willing to sell that to you for $457,000. Okay, so your first thought is probably, oh my goodness, I'm not going to take on another $500,000 in debt. Like, I can't do it. You know, it's way too much debt. I think everybody sort of panics as the numbers get larger. But I want you to take a deep breath and let's think about it, because owning the real estate is almost always the smarter play. So let's add that $457,000 to your bank loan. So similar bank loan as before, right? Everything about the practice is the same. So the new bank loan is 1.6 million. Okay, just for a round number, we're going to say that your new bank loan is 1.6 million. Again, 5% interest rate. But now, if you'll notice, the term is not 10 years, because when real estate is involved, we can take the loan term out all the way to 25 years. So depending on what the practice is valued at versus what the commercial real estate is valued at, we'll come up with a blended term based on that ratio. So, in this case, the practice, was 1,125,000 and the real estate's, less than 500,000. And so the blended term on this loan would be 15 years. Okay. Now notice what happens though, just by taking that 10-year loan term to a 15-year loan term. Your monthly payment, not a lot more, $12,650. Your yearly payment, not a lot more, $151,800. So now let's take your new debt service, the higher debt amount that you have annually, from your net profit of $225,000. What you're left with is $73,200. Now, we're going to add the lease back to that, right? The rent expense. So on that first expense page, when I said that would come back, here it is, because if you own the real estate, you're not paying that rent to someone else. So even though that expense is coming out of your practice, that rent is going back to you. Okay, so you're bringing that home at the end of the day. So you've got your remaining profit, your cash flow from the business, $73,200. You have the rent that you're paying yourself of $72,000, and you have your owner DVM salary of $88,000. So as a DVM owner with the real estate, your owner's income annually is $233,200. Now that's a significant amount of cash available for you to begin repaying some of your debt. Can you see with that number how quickly you could be student loan debt free? Okay. And so when we talk about student loan debt, this is really kind of just a synopsis of what we've been saying, but you're going to compare your DVM salary of $88,000 to your DVM owner salary, owning the real estate of $233,000. How much can you pay annually, and what does that do to your debt percent of income? Okay, see how dramatically that decreases that debt to income. Okay, so if you're thinking about ownership, here are some of our tips. And, I think that we talked to enough people that we probably could make a larger list, but this is our top, kind of our top 5 or 6 do's and don'ts. So one is understand the business and its differentiators. This is a space where you are competing, for market share. It's important to know, what you do differently than your competition. And the business that you're going to buy, you need to walk through it and think about, okay, what are they doing for the community? What are they offering? Is there a need that we're not meeting? How can we differentiate it even more? But understand the business and the competition both. Understand the cash flow opportunities. So what does that look like? When we look at profit and loss statements, there's a lot of what we call normalizing that needs to be done. And, you might want to consult with your lender or with a consultant or somebody to take a look at that, because as a DVM owner, there are also a lot of perks, accounting and tax, incentive perks that you can take advantage of. But we need to normalize those when a new owner is coming in, because they may not, use that same accounting principle. They may not have those same expenses. And so we call that normalizing the cash flow. Leverage your experts, have a team of experts, a lender, an accountant, an attorney, consultants. The most important thing when you are choosing your team is that you choose people and organizations that you trust and who know the industry. And so at the end of the day, I said earlier, if you can't service your debt, you're not going to be successful, and we're not going to be successful. And so the last thing we want to do is loan money to you for a practice that doesn't have cash flow and doesn't have the potential to be able to service the debt. And so we won't do that. We're going to talk you through that process so that you understand what that cash flow looks like. And you should trust all of those people on your team like that. And it is important that they understand the veterinary industry, because it's different than other industries. Expect the unexpected. Hopefully, the last year and a half has really taught us how to expect the unexpected, how to be flexible, how to pivot. We're all sort of, realizing a new norm, I think. And so there are going to be things that pop up that you're not going to expect. At the end of the day, it's all going to work out. But we do have to be able to step back and take a deep breath and be flexible and work through some of those issues. Budget and forecast future performance. It's important for you to be thinking about a pro forma. What does this look like a year from now? What does this look like 3 years from now? When you're thinking about business planning, that is a living, breathing document. So it's not something that you write, to hand over to me and then you put it on a shelf and you never look at it again. Just the same with forecasting. I mean, you really want to continually think about what's going on with your business, what lies ahead, what are we going to use for our key performance indicators, and how are we going to look at those to grow our business. Don't limit yourself based on what you see. So we want you to recognize that there is potential in a lot of these practices. Quite frankly, there are a lot of practices out there right now with owners who are just tired. They might have been getting close to retirement or ready to retire before COVID. This industry has been somewhat pandemic proof from a revenue generation, perspective. And so revenues are higher in 2020 and certainly the beginning of 2021 than they were in previous years. But that has been exhausting for a lot of owners. And so if they were ready to retire before, or they didn't have enough help to leverage that growth, they're tired and they're ready to sell. But you don't want to pay for potential. Okay. If you see a lot of potential in that practice and you know that there are things that you can project and forecast, we want you to see all of those things and be excited and plan for them, but you're not going to pay for that. Okay, that's going to be your sweat equity that you put into it. So you're not going to pay for that. Don't be emotional. It is really easy to become emotional when you think you have found the perfect practice and the perfect location and all of the stars are aligning. It's easy to get emotional and you're going to want to pay too much or make concessions that you shouldn't. This is a business decision. So at the end of the day, keep telling yourself, this is a business decision. You cannot make an emotional decision. Don't get into a bidding war because you're probably going to lose. And so if that happens, you've got corporate bidding and you have a seller who's interested in that, big check from corporate, sometimes it's better just to walk away, and let that happen and just know that there's another practice out there that you'll be able to find. But if you get into a bidding war, it's very likely you're going to get to be emotional and, you probably aren't going to win. And then lastly, this is a really hard one. And quite honestly, I was talking to somebody earlier today and they said, well, the seller's just not willing to give us their tax returns. That's personal. Like, no, that's not. That's business. They're selling their practice. And for you to get a good idea of what's going on, you've got to be able to see the past 3 years of tax returns and a current profit and loss and balance sheet. That is what you need to see as a buyer. And if the seller is not willing to share that, then there's probably something wrong. Okay. And so do not accept poor outdated financials from a seller. So you want to look at updated financials. The bank is going to require updated and reliable financials. And that's what you need in order to base your decision off of sound business and financial principles. So why us and what do we do? Well, we are a national preferred SBA lender. And what that means is that we make the process easier. The process is a little bit faster because we can do our own in-house underwriting. We are focused on the veterinary industry. And so, we understand the trends that are going on. We understand the challenges that you guys are facing. And it's important to us that we match our bank to your business. It's not a one size shoe fits all for us. We don't have boxes that you have to fit into. We want to provide that hands-on, one-on-one experience to you like you provide to your clients. And that's really important for us. And so Ashley and I work with you from the very first conversation. We walk you through that approval process. We then walk you through the closing process. We are with you 100% of the way. And then after that, we service your loan. And so we retain all of these loans in our portfolio. We don't sell them to another bank. You're not going to get that letter in the mail. You don't have an 800 number to call. You call Ashley and I, you call our cell phone, you send us an email, send us a text, and that's just how we do business. We do it all. So we do acquisitions and complete change of ownerships. We'll do partner buyouts if you went into business with a partner and you're ready to buy them out. Equipment, working capital, so expansions. We do all kinds of expansions, real estate. So all of those things we are able to do. We even do some startups, and I say that cautiously because I think that it is understandable that startups are exciting. And when you think about, oh, I can create this from the beginning and I can make it exactly what I want it, sometimes that becomes very emotional. And startups are a little bit difficult, especially coming out of a pandemic. And so think very carefully if you're going to do a startup. You need to have a really good business plan. You need to have some sound financial projections and expenses. Really, really do your homework on the market and the location. And we have done some startups. But I would encourage you, before you go down the path of a startup, be sure that there's not a practice in your area or in that area where you desire to practice that potentially could be for sale. Do not be afraid to walk into a practice and say, I am very interested in ownership, and what is your plan? What is your succession plan? And that owner, especially now, might just look at you and say, you know what, I'm kind of ready now, so let's talk. And so really think about those things. But we absolutely do it all, and we can help you with any of your lending needs.